Shrikant Bhatt, Managing Director and Head of Wealth Management with CitiBank. Shrikant, good morning. Thank you for joining us. What is your understanding of the news flow from Europe?
Yeah, hi, good morning. I think this is not the first EU summit. There have been more than a dozen summits since the crisis first broke out a couple of years ago. What's different this time is the backdrop, or the grim backdrop against which the summit is being held. So there is generally an air of expectancy that there will be some consensus on A, the short-term funding issues, and B, a roadmap which will lead to closer fiscal union, if I may call it that.
Shrikant, but does it seem like an ESM Spain bank loan status and the direct bank recapitalization are the key positives, and that is what is bringing about a flurry of activity in European as well as global equities, and that's also going to somewhat, bring in a floor to the euro-dollar equation as well?
That's right. I think market is reacting to bits and pieces of news as it's streaming on what is the kind of general direction one is seeing. Yes, with the current rates the way they are, especially with the Spain and Italy yields inching above the 7%, the psychological 7% mark, any kind of consensus that can drive these costs lower, closer towards the 5% kind of a rate, that's obviously seen as a big positive from a short-term perspective. But I think the bigger picture is this a more sustainable solution or not? And I think that's going to be a more long drawn-out solution, despite the short-term volatility that we are seeing right now.
So do you think today's market strength is a good opportunity to sell and get out?
I would say that we are still in a range trading market. We don't have anything firm or concrete to say that this is the turn and this is what's going to keep driving the markets higher. We've seen this in the past that there have been announcements. However, the follow-through and the eventual fructification does take some time. So from that perspective, I think it's good that at least we're seeing some positive notes. But if you note, yesterday during the evening closing, the markets were in a very different mood and a different form. So one needs to see how this gets played out over the next couple of days. And whether a genuine consensus which is more sustainable comes through.
Shrikant, what about India? Aside of the global news flow, which is positive this morning, we also got some clarity coming in on the GAR guidelines, which was pretty much an overhang when it came to the FII sentiment. Do you think these two factors are enough to sort of soothe investor sentiment? And can we now see more by way of inflows from FIIs?
Good point on this. Firstly, you're bang on target when we say that the biggest issue which is really impacting India right now is the sentiment. There is a qualitative and a quantitative element to it. So to the extent that the qualitative elements are being addressed through issuance of guidelines and also statements to that effect, and that does help. But the follow through in terms of what's being done, in terms of the subsidy rationalization, how are we going to be addressing the fiscal deficits and get it to a more sustainable solution? I think these are aspects which will need to be played out over a longer period.
So how exactly are you positioned in your India portfolio?
When we look around the region and when we from a Singapore customer perspective, we obviously have to look at it from an overall portfolio. There are markets today that are looking exceptionally attractive and are trading at book value. For example, Japan, it's trading below the book value. So when you look at and compare India with the peers, I would say that India would be at best a fair value. And from that perspective, there are other markets which look far more compelling at this stage.
But Indian economy is still growing at about 6%. Including inflation, 10% plus. Japan is not growing at all. So whereas Japan is expensive, India is where the growth is.
Sure. I think the issue really is, from a price book value perspective, also from an earning potential perspective. Today, emerging markets, for example, emerging Asia, broadly speaking, we are seeing that the markets are factoring in a 0.6 or 0.7% earnings growth, which is likely to be if the current trends continue, then it's likely to outperform that rate. Now compare it to India, even though it's growing at 6%, the valuations today do reflect that already. So from here on, how much is the upside one can expect? So that needs to really get, that needs to become a little more clearer before investor starts coming in droves.
But in your India portfolio, how are you positioned?
Okay, within the India, when we are looking at our customers, we don't really get into specific sectors within India. First, at a macro level, we obviously look at whether we want to be in which markets would we like to be in at this stage, and then look at specific sectors within that market. Within India, of course, the fundamental story stays. The long-term picture is very positive. When you look at the demographics, you look at the fiscal growth, and so on. So from that perspective, when we look at certain sectors like consumer staples, consumer discretionary, these are the sectors which continue to look attractive.
And what stocks do you like, or other company names do you like out of the two sectors that you just mentioned?
We do not normally comment on individual stocks.
At a currency level, are you advising your clients to still buy or hide in dollars, or emerging market currencies are now genuinely looking attractive?
I think the current crisis has arrested the secular story on appreciation of the emerging market currencies. Having said that, we do still believe that this century is really for the emerging markets to really do well, especially those which have fundamentals in place. So we do see that for the short term, yes, the volatility is impacting the currencies, and the currencies we are seeing a dollar strength with the risk of sentiment that we are seeing currently being played out. However, we do see that over a longer period of time, these currencies will appreciate and will continue their trend, which we have seen over the last 3 to 5 years come back into vogue again.
So are you advising your clients to buy rupee?
Yes, at tactical levels, yes.
Okay.
But the current sentiment is, of course, there is a overhang of the sentiment right now, especially with what's happening in Europe.
I just want to bring up the Nifty because 5250 is something that we've just crossed in trade. Did make a dash at 5250, 5245, but yes, just a few minutes back you were staring at a triple-digit rally for the Nifty. So we've had our touch-and-go moment with that level as well. The Sensex too holding up above the 17,300 mark in 5250. Not quite sustainable as of now, but we did make an attempt to cruise past that level. Shrikant, what about your views in commodities? For how long are we going to see a slump coming in for gold as well as crude prices?
Okay. Firstly, from the overall story, there has been a slowdown in 2012 over 2011, and that's what's getting reflected. The expectations that the global growth story is weakening. More specifically, countries like China, India, which are large consumers of commodities. There has definitely been a slowdown from the trend line growths that we have been seeing, and that's reflected in the price of commodities. Do we see these prices changing? Probably in the short term, no. There is going to be continued pressure on them. We have to make an exception between various commodities, of course. So the ones like oil, for example, we have seen a correction, copper. When we look at commodities like gold, however, I think gold is unlikely to lose its luster in the short term. We've seen a correction that has come about over the last few months, and that's largely driven out all the speculative longs in the commodity, and I think it's well positioned to continue to resume its bullish trend.
Shrikant, whereas Singapore bank accounts, they offer a minuscule interest rate of less than 2%. Indian banks now for NRE deposits are offering about 9%, about 10% returns. Are you advising some clients to use that arbitrage opportunity, invest in India, and then milk in a nice 9-10% return?
I think the interest rate differential is only one aspect of the yield play here. It's also, the fundamental credit when you look at Singapore, which is a AAA, versus India, which is, probably at a BBB minus at this stage, and also getting under some amount of scrutiny. So it's really about whether the customers and the investors are comfortable getting that sort of a yield, and they feel that the risk is commensurate with the reward they're getting.
So what you are saying is that the risk appetite, or currently investors are so risk averse, they are happy investing in a bank account in Singapore, which is giving a 2% return, versus a bank account in India, which is giving a 10% return. Is that the potential setup? Is that the current scenario?
Well, I mean, that's exactly, you're right. That's exactly what's happening, because when you look at what's happening in Europe, for example, you can see within a European Union, which is supposedly one single monolith, where European bonds are, and where the government bonds for, let's say, Spain or Italy are, you can see a huge gap there.
Okay, Shrikant.
So you're seeing a clear discernible, the difference which customers are seeing in the various credits.